Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, great week, wherever you are and whatever day it is for you. It is Friday on the podcast. We are back to our Friday routine, so we're bringing that good Friday energy to you. And it is almost Thanksgiving. Thanksgiving is next week. We're talking to you on the 21st. So Thanksgiving is next Thursday, I believe. So if you guys listen to this anytime around then, have a good Thanksgiving. I hope you guys enjoy time with your families and forget about real estate for a week and just relax. But not right now, because today we are talking with Matt Blair on the podcast from REI Capital Growth. Matt is a seasoned commercial real estate executive with over 15 years in experience. He's underwritten more than $5 billion in assets. He has a bunch of experience. He has an MBA from Wharton. So a lot to go into. Matt, I'm excited to jump into it. Thanks for hopping on.
Hey, thanks for having me, Gabe.
Absolutely. I told you before we get on here, we always like starting with stories. We like to hear how people got to where they are. So why don't you take us to the beginning of your story in real estate and tell us how you got here?
Yeah, absolutely. So real estate has kind of always been a family trade for me. My grandparents moved to New York in like the 40s and worked their way up to buying, a couple of apartment buildings in New York. And then that kind of became the family portfolio. I personally ended up on the debt side of the business after college. And I was helping the FDIC work through all of the commercial real estate debt that the banks made when those banks failed. So we were doing the foreclosure work for the FDIC and going through just reams and reams and reams of debt and valuing that debt to be sold in the secondary market. So that's how I started my career. And then I moved into kind of like a seasonal underwriting consulting position with Cushman & Wakefield and just kind of been in real estate the whole career.
Nice, man. That, that had to have been a unique experience during 2008 when the crash happened and there were so many distressed assets out there. I honestly don't know a lot about the debt side. I should know more than I do, but I don't. So how do, big banks, how do they value debt on the secondary market? How is, if you have a $10 million loan that's at 5% interest, how do you value it? Like, what is the valuation process?
Yeah. So, the primary thing that you're focused on is how much you can sell the underlying asset for. So as soon as the debt has gone bad, all you're focused on is the asset. So then you basically just go down into traditional real estate valuation. So, how much can we liquidate it for? What are the foreclosure timelines? What are the legal fees associated with it? You basically just do a long cash flow model that has a big lump sum at the end, and you just have to build in all the factors between here and there, and you're basically not getting any cash flow until it liquidates. So, so that's basically the process. It's a lot more simple than you would think.
So you're just reevaluating the property, how you would otherwise on a cap rate basis, and then if they're underwater, that's just that's too bad.
Yeah, well, at that point, they already are underwater. So now you're just figuring out how much you can actually liquidate the property for, and then putting a big fat discount rate on it back to today. And, that's how the private equity markets that buy the distressed paper, that's how they look at it.
Interesting. Yeah. So I'm sure you've learned a lot during that experience. Since then, you guys have moved on. You're starting your fund now, the REI Capital Growth. Tell us a bit about that. What brought you to start your own fund, and what are you guys about?
Yeah. So REI Capital Growth is, it's really the culmination of my father's life's work. We've been working together on this for several years, and the idea behind it is we're trying to offer a passive growth investment to investors. So everybody in real estate is offering passive income, passive income. Well, we tried to flip that on its head with the idea that one of the major benefits of investing in commercial real estate are the tax benefits. But if you're receiving passive income, you're leaving a lot of those tax benefits on the table. But if you're invested in a fund that's focused on delivering growth and reinvesting into more and more assets, we can be incredibly tax efficient on the fund side as well as on the investor side to deliver a lower risk compounding growth investment for our investors.
Makes sense. So what are you guys actually investing in?
So we like multi-tenant open air retail. So, think grocery store with 5 or 6 other retail locations attached to it. So these centers are located all across the country in every, small town. And there's, over 100,000 of them. And we like to invest in a certain value band. So we like kind of the $5 to $30 million price range. And in that range, you're going to be competing with less institutions because institutions like to write bigger checks. And you're competing with less individuals because only so many people can write, a check big enough to buy a $12 million property. So we think within that value band, we can earn a better risk-adjusted rate of return than lower or higher on that value band. Yeah.
I've been noticing between like the $3 to $10 million range, there's just better deals because of just what you talked about. Like anybody can buy a $1 million property, and if you're going for the 10 or the 15, $20 million, then you're up against really big money. So right. In that medium range is there's a lot more. I mean, it's the same amount of opportunity, but it's there's just fewer people actually looking for those deals. So that makes a lot of sense to me. So you said multi-tenant open air retail. That makes sense. Before the podcast, you and I were talking, and I was confused about the open air part, but you're talking about strip center retail with an anchor, right?
Right. So open air just meaning, the entrance to the retail location is exterior to the building.
Yeah, that makes sense. I have always been interested in that type of real estate. I've had a few of them sent to me, but I'm not confident enough to move forward in them. I've never bought one, never really considered buying one until they started being sent to me. So I am curious to know how you guys underwrite those. Just give us your 10,000 foot view. What do you guys look for? What's like a gold egg for you when you're looking at strip center retail?
Yeah. So strip center retail can be a very, very reliable cash flow stream because you have credit rated tenants, you have potentially medium and longer term leases, and these credit rated tenants, they pay their leases very consistently. Sometimes these companies go out of business or go bankrupt and they renegotiate their leases, but that's kind of more rare.
I'm thinking of Ace Hardware up here. I don't know if you guys have that on the East, but up here in the Northwest, there used to be such a big chain, and they're going down left and right. Home Depot is just gobbling them up.
Yeah, but the very interesting thing is, I have an Ace Hardware in Ann Arbor where I live, and it's store number 357, right? And that Ace Hardware is never going anywhere, right? So there's nuance within those calculations of understanding who your tenants are, how long they've been there, how embedded they are within the community. But also within retail, there are very simple things like if you're on the wrong side of the street, it's a totally different valuation than if you're on the other side of the street because there's easier access to ingress or egress, or terrible access because you just happen to be on the wrong side of the street. So there's some nuance in it, but really for what we're looking for, which is stabilized properties, we're not looking for large value add opportunities. It's really about the cash flow stream. And the biggest thing you need to worry about is if you lose a tenant, how easy is it going to be to release that space? So that's why it's location. But
it's funny you mentioned the wrong side of the street thing, because there, by where my parents live, there's this large retail, strip center retail, and there's this big anchor store, and it's right on the there's an exit to a major freeway and it's just right on that corner. And every time I go by it, I'm like, that is such an ideal location, but it gets turned over. I swear to God, every single year there's a new tenant there. And I don't know, you would think it makes, it's a good location, but I guess because it's of where it's located, it's kind of difficult to get to. People just don't, they don't go there.
Yeah, it's probably great for visibility because you drive by it all the time, but it's actually kind of hard to cross when there's a lot of traffic because there's just too much flow, and that happens a lot. That happens all the time.
Interesting.
So yeah, it's important to understand the dynamics and be there at different times of the day. When we do site inspections, we kind of hang out all day to kind of see how the traffic flows, see where people come and go. And sometimes, a strip center looks beautiful on paper and you go and you sit there and there's just nobody coming.
Almost people everywhere.
Yeah, there's people everywhere else except right here. So it's important to understand those things. But ultimately what you're focused on is just, retail traffic. Are people coming? Are they interested in what these tenants are offering? And can they get in and out, relatively easily?
Yeah. Yeah. That's interesting. There's a family here in Seattle that owns a whole block of commercial real estate. And I'm talking like downtown Seattle in Chinatown. But for some reason, the city of Seattle, they've been pushing homeless people there. And so they're suing Seattle because all of their major tenants, like commercial tenants, have left and they've tried to sell it to developers, and developers will go there and be like, we can't build here. They don't want it. And they can't get it leased up because nobody wants to start a business in a homeless encampment. And so, even in good locations, without knowing who the people that are actually in that location, that would have a big impact on your actual valuation. Makes a lot of sense to me. So let's go a couple layers down into the underwriting. I want to know specifically, like, what do you look for in the metro? Just give me all the details that you consider when you're looking at strip center retail.
Yeah. So the primary thing that we're looking for is the demographics of the location that we're looking at, right? What are the traffic counts? What are the foot traffic counts? There's a company called Placer.io, and they track foot traffic.
Oh, wow.
I don't know how they do it, but they track actual foot traffic into retail locations. So you can see how many people are actually moving around the center on any given day. Traffic counts are great, but foot traffic is actually even more important. So demographics of the local area, household income, we look to be above 75,000 on average. We look for at the labor market, how diversified is the labor market? If there's a single employer that's over 50% of the employment market, that's a little bit risky because, if they have layoffs, it's going to affect such a large percentage of your base. We also look at the lease rollover. If all of our leases are rolling over in year 3, maybe that's not the right lease mix that we're going for. You like to have staggered lease rollovers. Also the tenant mix. If it's all mom and pops, that adds a little bit more risk than if you have a couple of larger national tenant rated tenants as the anchors. That adds more value. There's a lot of different pieces, and no single piece is really a deal breaker, but these are kind of just general ideas of what we're looking for.
Yeah. Do you give me a rundown of the metros that you're actually looking to purchase in? Do you look for smaller tertiary markets, or are you only looking for like DFW, New York City, like bigger cities?
Yeah. So we stay away from primary and tertiary. We like secondary markets. So think suburban markets to major metros, 45 minutes to an hour and a half away from major metros, not too far out, but not too close. We find that there's even better yield in those locations. They're a little bit sleepier towns than a major metro because, in a major metro, number one, there's going to be way more competition. Number two, you deal with, what's happening in Seattle. Hey, there's homeless encampments and now, we can't get anybody to lease our space. Like it's kind of a newer phenomenon, but it only happens in those, downtown metro locations.
It's interesting. I don't mean to jump in here, but I bought a self-storage facility like downtown Lubbock, Texas. And I'm talking like downtown. And when I was doing the underwriting, I was like, this, the facility was very, very vacant. And I was like, this is going to be a slam dunk because there's no way that this can go wrong. And when I bought it, we just battled the homeless left and right every single day. And it was, that was my big lesson that location matters more. Obviously location matters a lot, but it also matters like what is happening at the specific corner that you're buying this. I mean, even if the population in a 3-5 mile radius is huge and there's like thousands of people, tens of thousands of people in that radius. If there is a ton of homeless or if there's issues in that specific location, it's just not worth buying, and it's not worth moving on.
Yeah, absolutely. And in the retail space, the retail center can back up to, a neighborhood that has a really high crime rate. And, that bleeds onto the property, right? So it might not be homeless, but it might just be, a scenario where the location is impacted by external factors that have nothing to do with the quality of the tenants or the desire of the residents to visit the center, right? So there's a lot to it. And the only way to kind of identify those issues is physical site inspections and long site inspections. You can't just pop in and out for an hour. You have to go and you have to hang around for a day, and you have to talk to the tenants, the people that work at the, local Starbucks or the, Subway or the grocery store. Say, hey, how do you guys like this space? Is it good? What are the issues you guys run into? And people love to talk. So you go in, you just buy a coffee, you start talking to people, and you learn a lot about the property, more than you could ever learn on an offering memorandum. Yeah,
absolutely. Do you guys have, so you talk to actual people that are frequenting these locations. Like if it's a grocery store, you go in there, you talk to the clerks, you talk to the customers. Do you guys, is there any other people that you call, like the police station, the local government? Do you, who else do you call to kind of get a feel for the location?
Yeah. A lot of times if you're there all day, you're going to see a police car. And so you just kind of go and chat them up. You can also talk to the mailmen. They have a lot of information for you.
Mailman, that's smart.
Yeah. Then you also just kind of go down to City Hall and, go to the planning board and kind of just chat up whoever's available down there and tell them, hey, I'm interested in this neighborhood. What can you tell me? And people are very interested in sharing their knowledge and their expertise. But you got to be on the ground. If you call, you will not get a tenth of the information you'll get if you're down there. So yeah, you got to have boots on the ground. That's a key component.
Nice. So let's talk about value add. You're not buying these to keep the cash flow where it's at. Obviously you want to force appreciation just a little bit. What are the general plans that you guys implement to add value?
Well, so our strategy is actually a bit different. We are buying stabilized properties with maybe a little value add opportunity in that we're only 90% occupied. So, hey, we can lease up a space and add some value that way. But the way that we grow our investors' capital is through our reinvestment strategy. So we buy a property, it's kicking off cash flow, and we reinvest that into another property. And that allows us to diversify the portfolio holdings, as well as have additional depreciation to write down all of that new income. And it creates a compounding effect. So we reinvest and we reinvest and we reinvest, and it grows and grows and grows over long periods of time. It's basically kind of Robert Kiyosaki's Rich Dad, Poor Dad model, but on a commercial scale.
Right. Yeah. Interesting. So there must be, what are retail centers trading for? Like what's your cash on cash return for a $3 million property that you guys are looking at?
Yeah. So all of these properties are stabilized. So we're not doing any negative AM. We're always going to have a spread between the cap rate and the interest rates. So interest rates are 6.25 right now, maybe a little less. And so we're looking at least a point to a point and a half spread over that. So 7.5, maybe 7.75 cap rate. So our cash on cash return is coming in a little bit over 8.5%, is what we target. Now there's times where we can do better than that, and there's times where we do a little bit worse than that. But we think our cash on cash return, which is what we're reinvesting and growing, is roughly between 8 and 9% on average over a long period of time.
Interesting. Okay. And are the leases gross or are they triple net?
Triple net, all triple net.
Even for the smaller locations, like the mom and pop, your hairdresser, your tax accountant, whatever.
Yep. We focus on triple net or double net or absolute. Sometimes we do an absolute net, but yeah, we focus on centers that are structured that way. And if they aren't structured that way, then we look to transition the leases into that. But usually the anchor that we're targeting is always triple net. And then maybe some of the smaller leases aren't structured in that same way. And when they turn over, we look to bring them up into the similar structure as the others.
All right. Makes sense. So we are running down the time. We've already hit 20 minutes, but I wanted to ask, looking at your crystal ball for retail, what do you guys see in the next 3 to 5 years?
So I personally, I really don't think that the real estate market has experienced the price shock that the increase in interest rates should have created. Right. So my crystal ball is really bad. I've predicted things my whole career and always been wrong. But I tend to think that they're going to drive interest rates back down, which is going to cause prices to even balloon up a little bit because they never really came down and people were still transacting. So as rates go down, the prices will go up even more. Right. So the asset bubble could get worse. So maybe we finally see that price correction when things just get too expensive or people stop buying. But for the next 3 to 5 years, I kind of think things are moving in the up direction with the with the moves that the Fed has done with the reduction of the rates. I don't see them stopping that. I think they should, but I don't see them stopping. And so I think the real estate market is going to continue to thrive for the next several years.
Yeah. I was surprised with that too. Since 2021, I just figured with the raise of interest rates, that would be calculated in the prices that you saw on market, and people still wanted the 5-6 cap for their property. And I'm just like, I don't get it. So we've been kind of confused about that one as well, but hey, it's all good. It's real estate.
Yeah.
All right. With that, I'm going to push us off to the quick question round. Are you ready?
Sure.
All right. Starts with education. It could be any form. It could be a book you've read, a conference you've gone to, a mentorship program you've been a part of, anything. I just need 2 recommendations, one for general life wisdom and then one for real estate.
General life wisdom, if you're going to be an entrepreneur, I would say listen to David Goggins. When you're having a rough day, he can pick you up and help you get through those rough days and just keep moving forward. And then real estate wisdom, if you're really just starting out, I do think Rich Dad Poor Dad is a good foundation of kind of how the mechanisms work. I've read so many real estate books and I don't have any that I just love. But Rich Dad Poor Dad was kind of how I was brought up. Like that's the core concept. So I always recommend that to people who are just starting out.
Yep. That's a good one. I like that you said David Goggins too, because he is, he has a very unique personality, but it's really good to get you up and get you going. That guy he's just an animal. The amount of running he does, I'm just like, how could you, I could not handle.
It doesn't make sense to me, but when being an entrepreneur just in general is really tough. When I'm dealing with regulators or something that, I'm really struggling with, I listen to him for about 5 minutes. I'm like, oh, okay, I can do this.
Right, I got this. If he can run 300 miles legs. A day.
Exactly.
All right. Next question is about Oh, nope. Next one is for your younger self. Let's go back to the Matt who was just getting started back in 2008, 2009, looking at that,
Yep.
revaluing those the debt for those foreclosed properties. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would I would say start buying for your own account immediately. Right. Hindsight's 2020. It's easy to see where the market's gone over the past 15 years. I had a very pessimistic view of the world at that point. I guess maybe that was
Makes sense. You were kind of looking at all the failures. Yeah.
Right. But, just to stay optimistic and start buying as soon as possible would be the one piece of advice.
Yeah, and that has been echoed so many times on this show. So we put it in the bucket of I wish I got started sooner. And anytime somebody mentions that, I always point it back to you, the listener. If you are listening to this episode and you haven't gotten started, this is your kick in the pants. Go out there, just get a deal done. Doesn't matter what it is. It could be a single family, a piece of land, anything. Just go out there, get it done, and get that ball rolling. Because 10 years down the road, you're going to be thankful that you got started today rather than next week, next month, next year, whatever it is.
Absolutely.
All right. Next question is about the U.S. It is a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today. Hey guys, quick break from the show. If you've listened to this podcast before, you know we are always talking about how important it is to have the right mentors and partners in real estate, which is exactly why I've opened up the Real Estate Investing Club online community. It's a place for active investors to learn, collaborate, and get real deals done together. And right now, it is 100% free to join. We host weekly calls where we review deals, talk strategy, and share tactics. Just click the link in the description below and come join us.
That's a tough one. There's so many great places to invest. For what we invest in is just the world is our oyster. So we focus on places with growing population bases instead of contracting. We focus on places with really diverse labor markets. Maybe Birmingham, Alabama. I really like Birmingham. It's got a really strong, diverse labor market, really strong demographics and household income. It's kind of sleepy. People don't really go down to invest in there. But yeah, that might be my favorite spot that I've been looking at.
Interesting. Yeah, there have been a number of people who've come on here and mentioned Birmingham.
Maybe I'm late to the party.
Well, no, I don't know. I mean, I do feel like it's an overlooked location. Definitely. I mean, most people want, DFW, anywhere in Florida, the bigger metros that are attracting a ton of people, but DFW does seem, it's got its fans out there. So it's good to hear.
Yeah. We tend to find those places a bit overvalued at this point, especially Florida. Florida's kind of gone a little crazy. But yeah, Birmingham is a good one. Nashville, Tennessee is another great place, surrounding communities around there. Maybe Louisville, Kentucky. That's a good spot. They've seen some good properties out of there. And then we've seen actually a lot of properties coming up in the Midwest. So, Wisconsin, Michigan, Illinois. So, there's always that Midwest contingent where there's opportunity, but I kind of like that Southern belt at the moment.
Okay. It's interesting. You said Illinois. I've always been curious. People say Illinois and Illinois, but you're in Michigan. So I feel like whatever you say is probably more accurate than what I said.
I said it and immediately regretted it. That's not how you say it. It's Illinois.
It's all good. All right. Next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what is your favorite way to generate leads and find new deals?
So because we're buying stabilized properties in that middle asset price valuation band, we are basically buying publicly listed properties. So we have very deep relationships with basically all the major retail brokers across the country, and they're just constantly sending us deals. Like our deal flow just organically from publicly listed properties is very robust. So we basically feel like we just get to pick the cream of the crop, and it's a beautiful thing. And then because we're reinvesting and constantly buying and buying and buying, we're developing a reputation in the market of being a great closer. So we're going to start seeing some of those off-market deals coming in as we build our portfolio and grow.
Nice. I love it. Yeah, it's crazy once you get known for buying any type of asset, mobile home parks, RV parks, self-storage facilities is what we buy. And as I've been buying more, brokers start to understand that, and then you just get flooded with deals, and it's really difficult. Yeah. The number of deals that I see is actually, I don't feel like it's a benefit to me because I have not figured out how to get through them, underwrite them quickly. It's really difficult with the volume that comes in. How do you handle that? If you get too many deals, it's almost worse than getting no deals at all. It's like there's too much to look at.
Well, so the nice thing for us is that valuation band kind of cuts out a lot of the noise, right? So, we're very focused on a specific target price. So, you never really get the target price, but you get the NOI. So if the NOI is in the right band, that falls into one bucket. And then you get the surrounding demographics. Okay, if it falls into these buckets, then it goes into the next one. So we have like some initial target benchmarks that thin the herd. And then we're looking at, I don't know, instead of 8 deals a week, it's, really digging into 1 or 2 or 3 deals a week to kind of, find that what's the expression in the haystack, a pin in a haystack?
Needle in a haystack. Yeah.
Needle in a haystack. Thank you. So yeah, it's a process of kind of just like whittling it down with some high level metrics. And we probably frankly missed some great opportunities in doing that. But, we just kind of zoom down to our credit box as fast as possible. And then we dig into those opportunities that fit the high level metrics. And then, we find that needle.
Yeah, that's actually a really good way to go about it. Because if you're looking at all the deals, it's too difficult. So if you just choose the criteria that you want specifically, number of pads, number of, how big the metro is, et cetera, then you can cut out most of the noise and just look at those gems that, actually fit your buy box.
Yeah. And focus on the metrics that are always provided in that teaser doc. Yeah. Because if you have to dig in to find the metrics that cancel it out, you're already wasting time. So, like I said, we're probably missing out on some great opportunities, but it's a much more efficient way to find really what we want instead of having to stretch or having to buy a property that's smaller than we want. We just kind of weed those out right away and then really zoom in on the ones we're looking for.
Yeah. FOMO, I feel like would get me hard though, because the best deals that I found generally, like I have to look deeper in order to find out why it's a deal. Like there's something in the P&L, like their electrical bill is super high or whatever it is that pops out in the P&L that I wouldn't have seen in the actual OM that comes my way. But I like in order to look at more deals look at the deals that you want, that makes a lot of sense.
Yeah, but I was going to say there certainly is a little spidey sense that you start to develop, and let me look at that one again. You just take a quick look and you throw it away, and you say, wait a minute, come back. And that certainly happens, where after you've looked at enough deals, you really start to get a sense that you can sometimes find those opportunities that would initially get kicked out just after having some serious reps under your belt.
Yep. All right. Next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something is going to go wrong. And that's when we get to learn a lesson. So what was the deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
So we bought a strip center in a tertiary location. And for the first several years, it crushed, like over 10% cash on cash return. Like we were doing really, really well with it. And we lost a major tenant in that property. And we assumed our releasing assumptions were built off of our experience in secondary markets, and tertiary markets are quite a bit different. It is very hard to back lease space in the tertiary market. So we had that space sit open for a very, very long time. And after a certain point, we just had to, cut our losses and vacate that property for, it was ultimately a loss on, what we bought it for and what we sold, but those years of cash flow, kind of made up for it. But still it's just, it's never good to sell a property for less than you bought it for. So that one hurt really bad. And that's kind of why we stay away
you've
from
learned
those.
the lesson, and you're not making that mistake again.
Yeah. Maybe one day in the future, tertiary markets can entice us with high cap rates again, but we're going to do that extremely cautiously.
Yeah. One thing I've found, or one of the reasons I have stopped really looking for the tertiary, like really small markets for us specifically, is it's hard to find good people to work in the area. Like if you lose, a property manager for us or boots on the ground, it is really difficult to replace them with somebody that is reliable. And that's why, at least for us, that we're just, I'm not a super huge fan, even though there are great deals out there. If you live in that market, sure, go for it. Awesome. But if you don't have that network, it's difficult to get a deal going the way that you want it to.
Yeah, that's a really good point. Because we work with a third party, nationally recognized property management company, because we own properties kind of all over the country. And they don't necessarily work in every tertiary market. They work in some of them, but they work in almost every secondary market. But once you start getting down into the tertiary, they say, yeah, we don't cover that. And that's a big problem for us. So that's a really good point. And I completely agree.
Yeah. All right. So that was lessons learned. Let's talk about the other side of that. Sometimes things do go right, and the deal kind of sticks out in your mind as one of your favorites. Take us to that deal. What was it, and what'd you like about it?
Yeah. So we bought a shopping center in 2012, and it crushed. It was a coming out of the financial crisis. We bought it at a 10 cap, and it was pushing out well over that in cash on cash return on an annual basis. The only regret I have with that property is that we sold it, and we sold it for a huge gain, but our whole methodology now is, why would you sell anything that's crushing, right? Keep it as long as you can. So the only regret I have is that we sold it for a huge gain. And, that's kind of the beginning of this whole strategy that came into creating our fund, was that first property that just, we knocked the cover off the ball with that one. And we've loved, multi-tenant retail ever since.
Yeah, that's funny you say that, because I just made that decision. Maybe it's a mistake. just recently, the very first two self-storage facilities I bought were in the DFW metro, but they're really small. They're like I think total it's like 16,000 net rentable. And so I just listed them just recently. They were I crushed the deal. They're doing fantastic. But I was realizing that my return on equity was really low. And so I finally decided to sell them just this month. Maybe that was, that was a mistake, but hey, whatever. At least we still did well.
Yeah, no, it's a tough decision, right? And especially, for us, we had, a syndication of family and friend investors, right? So we had to return capital to them. We didn't have to do it so quickly, but we wanted to really knock the cover off the ball in a very short period of time. But part of that experience is what led us to creating the fund, which gives us a longer term horizon, as opposed to having to close out individual properties one at a time. So it's kind of part of the origin story of how we got to where we are now. But every individual property is a different decision. So I totally get it. And it's hard. It's a hard decision to make.
Yeah. Yeah. And I mean, that's one of the benefits of the fund model is you're not stuck to that specific type of timeline. A syndication, you're doing 3 to 7 years. You have to return that money to the investors. And so makes a lot of sense why you guys are starting that.
Yeah.
All right. And
Yeah.
this is the second to last question. This one is a new question we've been asking. It's about AI. AI is relatively new, and I've been trying to implement it in as many ways as I possibly can responsibly in my business. So I like to ask people to come on. How are you implementing AI in your business today, or are you?
We are very carefully. So I don't know if I mentioned, but we're qualified with the SEC under Reg A Plus, so we can accept many small balance investors, right? And so our goal is to have hundreds or thousands of investors coming into our fund. So we're using AI to help us manage that flow of potential investors in our CRM, as well as we're contemplating an AI SEO strategy to help increase the visibility of our website to drive more traffic into our fund. But it's kind of on the outward facing, and a little bit on the CRM to help manage just kind of the volumes of people coming in, what stage they're in, what they need follow up with, et cetera.
Nice. Tell me a little bit more about the AI SEO, because I've been using AI to do SEO on my stuff too, and I'm curious what you guys are doing.
It's an interesting strategy that we haven't deployed yet.
Okay.
But the idea that we came about was there's many people in individual locations around the country searching for deals, right? Properties to buy, to rent near me, type of thing. And there isn't a great service that aggregates those deals and shows you them and gives you any type of valuation expertise around how to evaluate those deals. So the concept is, deals near me, and, our website will pop up and show you a list of deals that were scraped from all the listing networks, and throw on a little calculator on top of it that says, this is what the average rent is in this area, and this is what, cap rates are, and this is what the valuation looks like, and just like some very high level metrics, back of the envelope math to help people evaluate transactions, but kind of capture that locational aspect of it, because nobody else seems to be doing that at the moment. We're working on it. It's very complicated. It's a lot more complicated than I thought. But if we get 50 or 60 people in each little, city, looking at our website every month, I mean, that's a big deal.
Yeah. Well, that is one strategy that I've actually tried, and it does work. So I tried it for, I bought a bunch of domains, sell my house fast, X, city, state. And I was trying things out, trying to learn AI and kind of figure out how it worked. So I bought, I think it was 20 or 30 domains with that formula. And then I used Lovable, or was it Bolt? I can't remember. Maybe it was Replit. One of those, AI development softwares to create websites for them, with the formula to rank for SEO for those specific keywords. And I launched them, and they all started to rank. And so, we start to get leads through that way. And then I tried it again with mobile homes, sell my mobile home fast or something like that. Sell my mobile home today. I can't remember. But we got it to rank, and we're getting people sending us their mobile homes. And so that specific strategy of just trying to rank for very tight locations, I can tell you it does work. And people, you gotta hop on it while it's available, because it's definitely effective.
Yeah, that's great to hear. It validates the idea.
All right. Well, that brings us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
So number one, they can find us on reicapitalgrowth.com. It's our website. And what you can expect to reach when you reach out is conversation with the founders, either me, my partner, or one of my partners, right? So we are infinitely available, and we love to talk to everybody about real estate. We're also happy to be a resource to people that are just starting out and want to learn. So if you reach out to us, you're going to actually talk to us. You're not talking to an AI call center.
Nice. I like it. I will put that link in the show notes. So if you guys want to reach out, all you got to do is click the little more in the description. It'll pull down that full description. And in there, you can find his links. All right, Matt, that wraps it up, man. Thank you very much for hopping on the show.
No, thank you. I really appreciate it.
Absolutely. And for everybody who's with us today, first of all, I apologize if you guys are on YouTube and you're watching and you've seen my coughing. I've gotten a little sick, and so from my daughter going to preschool, and so I've been trying to at least not cough into the mic. But if you guys are here, we appreciate you and thank you very much for hopping on the show. If you guys want to support the show, just leave us a review, a comment, any of that stuff. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.